All right, today is August 13th, 2024. And what we're going to do is we're going to have a quick preview of the CPI print tomorrow. We're going to analyze what could happen in terms of both the rates market and also equities. We're going to also analyze some seasonality and a long-term view about equity markets. And we're going to finish off with some trade setups in both in Treasury ETFs, Bitcoin, as well as gold. All right, let's get started. So tomorrow, August 14th, Wednesday, tomorrow morning, we're going to have a set of CPI reports for July. So CPI is the consumer price index for urban area only. So it can be quite different to PCE, and it's been consistently above PCE in the latest rate hiking cycle. So the market expects the headline CPI to come in 2.2% month on month, which will be flat year on year as before at 3%. And core CPI is expected to rise at 0.2%, so a little bit faster than June, but on the year on year basis, because of the base effects, it will come a touch lower. And if CPI, the headline core CPI, come in line with the expectation, this is what we expect to see. So the headline CPI should stay the same over here, but overall we're in a sticky, but still quite contained area just above 3%. Core CPI, which is more important factor in the later stage of this rate hike cycle, has come down quite significantly from 2 years ago, and it's heading in the right direction. So if tomorrow it comes in line, we're going to have a nice lower reading, and it will give the Fed more confidence that they're moving towards the 2% inflation target in the PCE, because there's correlated effects. And I think this is a more important chart, because back in Q1, this is the 3-month annualized CPI rate. All this means is we take the last 3 month on month reading and extrapolate for the entire year, right? And if you look at this, everything, the headline, the core CPI, and the services, less shelter CPI, they were rising into the end of Q1, which got the Fed essentially panicking about whether the rate hikes are not enough, whether they should stay high for longer, and if we're going to have a resurgence in inflation. Luckily, we didn't get that. And actually, ever since the end of Q1, everything's been falling very rapidly. So if tomorrow everything comes in line, we're going to get a 2% core CPI on a 3-month annualized basis, and only 4.4% in the headline. And 0.4% is very little, because if the Fed's target is 2%, even is on the PCE, 0.4% is much closer to, essentially zero deflation into the disinflation territory. And I think the important thing is this: if the CPI comes in a little bit higher, the trend is not going to, the downtrend is not going to reverse straight away. But the risk is that if the CPI comes lower, especially the headline CPI, we might actually touch the negative territory on the 3-month annualized basis. And that would be an advanced signal of potentially the Fed having done too much rate hikes or staying too long at the current rate. And we were headed towards deflation instead. So you will read a lot of news headlines talking about potential for, a Fed being behind on the rate cuts, and we're heading towards the deflationary territory. This is the past 4-month report on the year-on-year basis. I put this in the article today, but I just want to explain this a little bit better in person, because it can be a bit overwhelming. So these are all the year-on-year factors of the CPI components, and each component has a different weighting in the overall index. And as you can see, that food and energy actually matter very little in the overall scheme of things. Together, they only account for 20%. When you look at something like services, so essentially services less energy services and all that stuff, it accounts for 60% of CPI And then if you look further down, shelter, a third of overall CPI reading in terms of weighting. But that's not the full picture. Because shelter has been hotter than all the other components, apart from car insurance essentially, and tobacco, it contributes a disproportionately higher portion of the CPI than everything else. So if you look at something like, used cars, they're actually in the deflationary territory. Apparel is basically flat year on year now. But all of basically over 60% of CPI actually just comes from shelter because they were hot and they have a high weighting. And within shelter, we have rent, which is the rent as we understand, if I were to rent an apartment, but also the owner's equivalent rent of residences. And this is quite a laughable component because this is actually like a fictitious rent that house owners supposedly would pay if they were to pay some sort of rent. And it actually has consistently come above the actual rent, right, by 0.3, 0.4% year on year. And if you look at the overall contribution, it contributes to half of the overall CPI. So CPI is very, very sensitive to shelter and, more importantly, owner's equivalent rental residences. And this is what inherently makes CPI prediction very tricky, because this is this is essentially a black box measure that the BLS kind of doing their own math in their department, and we don't really know how they come to this conclusion, right? And I track the rent index by Zillow and also housing market, but it's really unclear how they come to this number. But we're going to give it a go anyway today. I just want to highlight that not everything is really predictable, and even if you do all your homework, is not that predictable or interpretable, essentially. And another hot measure is car insurance. I didn't talk that much about it today, but in the past I mentioned that essentially this is a lagging factor to car purchases that were rising in COVID, and it has now significantly fallen. And you can see that new vehicles and used car tracks essentially flat or deflationary at the moment. And this car insurance measure should come down in due course. It still contributes towards 20% of the inflation reading we're going to see tomorrow. But it should be coming down. And the reason it's been so high is actually there's a host of reasons. First, more cars on the road, more accidents, newer drivers, and actually that leads to bad driving or worse driving overall. And so the insurance premiums have to come up to adjust for that. So you probably never thought that bad driving causes inflation, but it actually does quite significantly. And also there's been supply chain bottlenecks on the parts, on the repairs and stuff. So everything, since COVID and Ukraine war has essentially pushed insurance up, but I think we're now having a nice falling trend. So today I looked at the RDC data on housing. So July, we actually had a quite big dip in the house prices. So even though we had started having a downtrend since May, between May and June, we actually touched negative month-on-month territory. And so the overall health of the housing sector is not very strong. And if you just look at the supply and demand activities of housing, so the active listing count and median days on market and new listing counts have all fallen in the past month. So buyers are not really willing to buy and sellers not willing to list. So the housing market is coming down. We did expect this. The Fed also did expect this, because essentially the housing market has a reactive function towards high interest rates, high mortgage rates, higher borrowing costs. Basically, essentially, when people start renewing their costs, essentially it makes housing less affordable. And rent has kind of diverged in the past couple of years because people switched to renting more than buying. But essentially, it can't get too out of hand. It has to kind of move in line with housing prices, because essentially it's a yield on the house price, if you think about rent as an investment for the landlords. So in terms of the rent, so we use the Zillow rent index. It still fell in July. It was so it's a more volatile measure than the CPI. So the CPI is quite smooth, right? It's coming down steadily, but the rent index is actually a lot more volatile. So this area here surprised me a little bit because the index went up, but the shelter component of CPI stayed flat. So, and when the index went down, the shelter CPI also went down. So that makes me think in July it went down again. We're also going to have a downturn in the shelter CPI. So together, combining the house pricing picture and the rental index, I think we are going to have a much cooler shelter component for CPI, which means it's potentially CPI can be lower than consensus. So the risk is on the lower side. And then now I'm just looking at the car insurance premiums that changed month on month. This is by all 50 states. So essentially it cooled down a little bit. It still grew by 1.9%. But compared to June, it's a slower pace. I think on the year-on-year chart, it will translate to slightly higher year-on-year reading because of base effect. But still, I think this is not something the market should worry too much or be too concerned. Then I'm just going to briefly talk about this, the Global Supply Chain Pressure Index. So this index is designed by the New York Fed. It measures the historical costs of transportation costs as well as manufacturing costs around the world to identify if there's been supply chain pressure, for example, out of Asia or out of America. And what we found during COVID is that this is a standard deviation against historical mean, and the history goes back to 50 years. So during COVID, this shot up a lot. It went up to 3 to 4 standard deviations. And it then undershot in beginning of 2023. It's now reverting back to mean. So overall, this trend is trending up. I think I saw on Twitter a lot of people saying, "Oh, transportation cost has come up. It's a really dangerous signal." But against the historical mean, it's not something we should worry too much about. I think if this crosses above 1, we can start raising an eyebrow and worry about the overall headline inflation, not just the services component. Again, oil had fallen during July. The June CPI came in with oil energy CPI component down month on month, and that really surprised me because in June oil prices actually went up quite significantly from low 70s to low 80s, so more than a 10% increase. We still had a down reading anyway. In July, it reversed all of the June readings. So we went from low 80s, mid 80s to essentially mid 70s at the end of July, and then went a bit further at the beginning of August. But so I don't think oil should be a significant factor if here. It could contribute towards towards a lower headline inflation, but I don't really see it as a threat for higher inflation. And this is the fun part. So I've started. So my analysis starts with the rates scenarios. In this column here is what currently the market price is. So it says 44 here because that's the futures pricing, but in reality, it just means something like 80% chance of a 50% cut. Sorry, 50 basis point cut in September. And then we expect 5 consecutive 25 basis point cuts and then two more 25 basis point cuts in the second half of next year. If CPI undershoots, I think we're going to push for 50, so if the 50 in September is done deal, as perceived by the market would start pricing another 50 basis point for November. So remember, just a few days ago, we actually did get 50 basis point priced in for November as well, and it has retraced to 25 basis point. So I see market trying to push for more cuts in the next two meetings. And so I think this will definitely happen. It could be 50-50, but it is at least a good chance of a 15th November. But also what could happen is that we start pricing in more cuts in the second half of 2025 as well. So we could have 50-50, 25, 25, 25, 25, and then alternative meetings of 25 basis point cuts in the second half of 2025. So together, this should bring the terminal yield something like 50 basis point lower than what we're pricing at the moment. If CPI comes above the expectation, as in it overshoots what consensus has, we may see the 44 basis point for this September being pushed back to 25 basis point. And we may see November cut being also scaled back in terms of market expectation. But if the market scales back the November cut, what they're going to do is they're not going to just raise the terminal yield. What they're going to do is they're going to put in an extra cut on the back end of 2025. So I think 25, so it gets a bit more distributed over here. So essentially one more cut gets pushed out rather than being removed altogether. So I think in terms of math, this will be quite a big shift in the September meeting, but I think on the back end of the curve, not that much change on the absolute level. So just to visualize that on this screen, we're going to have if CPI comes above, so undershoots the target consensus, we're going to have the yields moving in this direction here, over here in the front end, as well as the back end. But if the CPI comes more benign, comes higher than the expectation, which is actually worse for us because inflation is too high, then I think the market will price in a little bit higher for longer. So maybe less chance of a November cut. So this is the visualization of what I just discussed. So now on to the implication on rates. So so we've been tracking this for the past week, actually, since I wrote about TLT. I think the wave 4 retrace here on the 30-year bond yield and also wave 4 pullback on the TLT was a little bit deeper than I expected, but it was still way above the top of wave 1. And I think now wave 5 has begun. Tomorrow, if CPI comes below consensus, is falling more rapidly, we can see yields falling, i.e. we're moving the 30-year yield towards the 3.85% target, and the TLT moving to above $100 and $101. I do feel wave 5 has commenced, but obviously, with markets, this is the thesis. This is our main expectation, and it's very likely to happen. There's always a chance that something completely unexpected happens, and we retrace all of these gains back below the wave 1 high, and that will invalidate this entire move. In which case, I will have to reanalyze what's going on, and the risk. And there is and I want to highlight that risk because the wave 3 high here is still below what we had at the beginning of 2024 when the market expects 7 cuts at the beginning of the year. So I think if it moves above, clears this high, we can comfortably say we're near wave 5. But as long as it stays below this high, I think there's always a chance that we might retrace all of the gains, in which case we have to reanalyze whether this is just maybe like a bull trap. So the question is, okay, so it's quite clear what could happen in different scenarios for yields. How does that impact equities? This is something I track on my spreadsheet on a daily basis. I look at the liquidity levels on the Treasury general account and the reverse repo program, the 10-year bond yield change versus the QQQ and SPY. What we found at the beginning of last week is that so falling yields, because of the risk off sentiment, when yields fell, equities also fell with it. And that's a very typical risk off move because investors are looking to buy risk-free assets and move out of risky assets in a risk off scenario and vice versa on the risk on scenario. Moving into this week, I think it's been a bit less clear. I mean, yields have moved up, like I mentioned, in terms of the wave for retrace. Equities also moved up. But, coming the past couple of days, it's not that clear on the correlation. And when I run the 30-day correlation between those variables, there isn't really anything correlated at the moment. So it makes the predictive function of equities a little bit harder for tomorrow. But we're looking for other clues. So we're looking at the past 3 CPI reports. In May, CPI came in line with expectation, which is good news. And in June and July, CPI came below consensus. So essentially, it was falling faster than what the market felt. Yields moved down on the day. It is quite clear, a clear big move, which is a very typical reaction, like we just mentioned. But equities, what happened to equities on the day is, it rose this day, it stayed flat. Oh, it actually rose again this day, and it finished at the same level as the open, and it fell the day after. But overall, equities were rising into CPI, and it continued to rise for a few days after, 3 or 4 sessions after. And then after that, the market starts to consolidate, and then we saw the high, we saw the high at the end of the month in July. So we're having the same pattern again coming into this month CPI in August. So I actually think we might get a positive reaction on in the equities market. And the rationale would be that if CPI is coming down, which is what the Fed was focusing on in terms of inflation target, they've been focusing on it for 2 years now. If it's moving towards the target, it means the Fed is more willing to relent and do cuts in September and November and December. Whereas in the previous scenario, when we had non-farm payrolls, which the Fed had dismissed as being in a normalization process, we have bad data. The market is worried that the Fed is not willing to address that problem and therefore causing the risk of sentiment. So I actually think tomorrow, good news could be just good news. Better CPI is better for equities and the lower yields. And so I wouldn't be bearish on equities working in tomorrow. But I will talk about the seasonality factors later. Going into September, it could, and Jackson Hole towards the end of the month, it could be a tricky period. And as you've seen here, the rising pattern lasts for 3 or 4 sessions in each time, and we usually get into consolidation after. And this is another thing I want to address. So this is the carry trade chart, the spread between the US 10-year bond yield versus the Japanese 10-year bond yield. So since the beginning of July, QQQ, the stock market, and the spread have moved together, both towards a downtrend, because Japan raised interest rate and we're pricing in Fed cuts for the next quarter. So the truth is, most of this spread is actually driven by the US Treasuries, because the Japanese bond yield is is very low. Is only is very low. Is within 1%. So you are not going to get a lot of movement in this spread just from the Japanese leg alone. So the US bond yield contributes significantly to the movement in this spread. And since the crash or the correction on Monday last week, what we saw is that spread coming back up because the US yields have risen. And equities also rose, right? But look at this part here. In the past couple of days, yields have come down, like we said, wave five is beginning, but equities still rose. So that kind of signaled to me that this relationship, the risk on, risk off relationship, might have also broken down based on this chart. And equities may continue to rise on weaker spread. And plus, most of the carry trade has been unwound. So I really think the impact of this is not as severe as some analysts may say on, for example, Seeking Alpha. Another thing we look at in terms of risk on, risk off is the junk yield spread, junk bond spread. So this is the junk bond as a CCC grade a option adjusted spread, and this is the spread above spot bond treasury tenors. We saw this spread rising since the beginning of March. And actually, we had a really big spike at the beginning of last week. But now it's come down quite a lot. It's still at an elevated level. It's still higher than what we had in July. So I wouldn't completely dismiss the risk of sentiment, but it has retraced a lot, which provides a little bit of comfort on how the equities could react tomorrow. So there's definitely no absolutes. This is all relative, and we're just trying to paint a picture of the underlying market dynamics. And then finally coming into seasonalities. So this is SPY and QQQ seasonality for the past 3 decades, essentially. September is a very bad month. October is fantastic, but September is very bad. So I think if equities rise into the month end after CPI, it might be a good opportunity to take some risk off the table or start hedging a bit more. I think some early subscribers might remember that I posted those charts just for election years. And August was a very strong month. And actually, if you put aside the Monday crash, it's not been that bad a month. But the problem with election year charts is that the sample size is automatically reduced by 3/4. And so you only get a sample of, instead of like 25 years, you only get 6 years, for example. And that's really not a lot of data to go by and say with confidence that this definitely will happen. But I will tell you one thing, on all of the election year charts, September was very ugly. So it makes me feel like if August has no hope, September will get worse. VIX last Monday closed 38.6. And I think a common question is this really bad thing for the market? Or does this signal some sort of bottom? I looked back the historical data, I think for the past 4 decades. For the past 3 decades, because since the inception of SPY. So the different color dots just signals the forward return. So if VIX closed at 38 today, in 1 month's time, what is the return on SPY? What's the return in 3 months' time, or 6 months, and 1 year? And obviously, equities markets generally go up. So that's why the 1 year returns tend to be higher than the 6 month return, etc. But it's not too bad, right? So the overwhelming majority of future returns when VIX close between 30 and 50 are pretty good. They're positive. And the longer you hold, obviously, when you look at the 1 month return, it clusters more close to 0. So it's a bit random. But when you look for, and also the 3 month return as well, they're generally positive, but closer to 0. But when you get into the 6 month and 1 year territory, essentially equities have can rise a lot higher. So this makes me a bit more optimistic on the medium term and the long term outlook. Another chart that makes me quite optimistic, and this is something I haven't written in my articles yet, is that the earnings yield on the SP 500 moves very closely to the 10-year Treasury yield. This goes all the way back to 1970s. And we can see that essentially, so what is earnings yield? Earnings yield is basically inverted PE, price per earning. So 1 divided by price per earning. A high earnings yield means low PE. It means equities are cheap. You're getting more earnings in return. Low earnings yields means high PE. Equities are expensive. Equities have become more expensive, were more expensive between 1980s and the dot-com bubble, obviously. We all know what happened. And also in the past 10 years, equities also have gone more expensive. So the earnings yields have reduced. But that had closely correlated with the movements in the 10-year Treasury yield as well. So the 10-year Treasury yield has considerably come down in the past 30 years since the 1980s. And what that means is that it gives basically a lower 10-year bond yield in the long term is more supportive of equity valuations. So I think I saw a lot of people cropping out this chart here from the 2010s, showing that earnings yield has come down significantly in the past decade. And they've only shown this red line here. They haven't even shown the 10-year bond yield or this section over here. So, but looking at the bigger picture, yes, equities have become more expensive. But if the 10-year bond yield does fall, which I expect it will in the next rate cut cycle, there is more room for equity valuation to get higher and the earnings yield to get lower. And actually, very often, if you look at this 20 years between 1980s and early 2000s, earnings yield was consistently below the 10-year bond yield, right? So, so people were just willing to bid on equities essentially, and equities are getting more expensive, and the market was moving up. So there's no reason why it couldn't happen here. So in the long term, this chart doesn't make me feel like there's more room for equity moving higher. And now we're flipping the chart to say, where is the 10-year Treasury yield historically versus the PE, price per earning ratio? And generally, higher yield, lower PE, lower yield, higher PE. And we're here. So we're kind of in the middle of ballpark, given where we are in terms of the Treasury bond yield. There have been instances where PE ratios have gone higher, towards the high 30s, mid 30s. And there were instances where actually PE has gone lower. So I wouldn't just say, based on this chart, equities will crash, but just zooming out, it gives us an idea of where we are. And so I wouldn't just say, oh, equity expensive is bearish, etc., etc. I would evaluate against the historical standards and also other assets. Finally, we're moving on to Bitcoin. Actually, before I move on to the Bitcoin section, does anyone have questions? Because this is quite nice to close to the Q&A right here before we move on to the next section. You can unmute yourself and just ask the question, or put your hand up and I'll unmute you. That's fine.
Hey, Yamin. Thanks for the presentation up to this point. How are you doing?
Good, thank you. Yeah. Hi, Jake.
Yeah. Thank you. Thanks for talking about this. My question, I think it got answered at this point, but it was like tomorrow. So it's tomorrow's CPI, and then you have jobs coming out. So what I'm wondering is, where's the risk going to? Maybe that this isn't part of the conversation on today's date, but I'm wondering where the risk is going to be to the downside. After short term, we've just seen a surge in equities. And good news is good news, bad news is bad news. Like, there's this flip flop. So you answered a lot of my questions, but I'm wondering what impact jobs will have on volatility in the market and direction.
So I think, so before we have the next set of job report, we are having the Jackson Hole symposium where Powell is going to give a speech. And I suspect he's going to address the weakness in the labor market. And he's going to talk about whether at least he should talk about whether, whether this spike in the jobs unemployment rate is something the Fed should be concerned about, and the market can agree or disagree with him. So what we saw is that the Fed had been adamant that, the sum rule that got triggered and the unemployment rising, it's just a normalization process from a very, very historically tight labor market with a huge supply-demand imbalance back in COVID. And if you look at where the base for comparison for the sum rule, we had 3.4% unemployment rate last summer, which is last spring, which is extremely low by historical standards, and 4.3% is still quite low historically, right? I think the market is more concerned about the speed that unemployment is rising and the fact that firms are not willing to hire. So I think before the jobs report, Powell has to address whether the Fed is willing to commit to quicker rate cuts if the next set of job reports shows even higher unemployment rate. And I think the second part is if we do get a high unemployment rate, I do think it's going to be risk off again, because the market just will get very fidgety about, Fed not cutting enough, not committing to a September cut in the first place, let alone 50 basis point in September or November. So I think we will get weakness. And plus, September is a very tricky month in terms of seasonality. So all those factors together, I can see a short-term pullback. The charts I've shown in the past 3 slides are more for the long-term or medium-term, 6 to 12 month evaluation of where equity is. So I do think the next Jackson Hole seasonality factor and next job report could see a pullback in equities and actually also lower bond yields as well. And we move into the risk-off mode again. I feel like the Fed has not really given enough clarity so far on what they're going to do about the job market. And they haven't really, Powell hasn't had a chance to address it. So until he speaks, I think the market will just stop pricing all sorts of scenarios, 50 basis point cut in September, 25 basis point cut in September, 50 point basis cut in November, et cetera, et cetera. So that's where I see the weakness comes from in the short term. Yeah.
Thank you.
All right. Thank you. So if we move on to the Bitcoin section. So for Bitcoin, I shared this chart in both the chat and also in my article today. Essentially, I've planned out 2 parts here. The path in black is what I have as primary expectation. And the yellow path is the secondary alternative expectation. And I just want to clarify that. The reason I have 2 plots is not to hedge my bets. It's more to say, technical analysis is inherently subjective. And I'm following, the best I can on the wave theory and in some of my experience of what happened before, etc. But the market is reflexive and always evolves, always moves faster than what we fixated beliefs about the market. So it's always good to have a plan B when the market doesn't deliver what you expect. The reason the yellow count is a secondary expectation going into today is because if we had a 1-2 here, that wave 2 is a very shallow pullback. And usually we get a very shallow pullback in wave 2, only in a very bullish market, which doesn't feel like today's market. And that wave 2 pullback is 0.382. So what I had is a 5-wave up into 62K, and that's my wave 1. And I see a small ABC correction to end wave A here, and a wave B up. But now this is the tricky part, because wave B here is actually quite steep, steep. It's gone past the 0.618 projection I had before. So what 0.1618 of all of the wave A it basically topped at 0.786. That happens also again in the very bullish market. If this moves further beyond this initial wave B here, I think, or even this wave here at 62, I think definitely first the bottom is in and we can follow the yellow path. Till now, we have a chance for this to fall further towards 55K. And now every time I think I post a chart saying, there is room to fall before this chart back then, people always seem to be in disbelief, thinking, how could it go from like 70K to 55K, for example? But it has, right? In the past few months, it's just been extremely volatile with government selling and miners cutting their position, etc. And also yesterday I posted when Bitcoin was trading, I think just around above 60K, I said, even though my primary expectation is this black path here, I actually don't mind setting up a trade here with a stop loss at this wave below, which is like 2.5% stop loss, pointing towards this 70K target, which is a 20% target. So that's a 10-to-1 risk reward ratio, which is pretty nice, to be honest. So I think that sort of risk reward ratio is pretty good, even if I don't think the probability is very high. So coming to today, I think there is a potential that we're flipping towards the yellow path. I just have to watch more of the price action to confirm. And if it does go through the yellow path, it kind of means wave 3 is on a 3-wave action, so ABC here, rather than a 5-wave motive motion. Or we can have a 1-2 here, and actually this entire chart will have to extend higher because of the wave 3 should be higher based off this high and low here. So I'll post more updates as we go, but this is a kind of, I'm just suggesting that here we're at a crossroad where Bitcoin could be choosing the yellow path versus the black path. Yesterday, I posted an article about gold, and I actually looked at gold, all of gold's history. History as long as we had charts. Obviously, we can't go back behind here. I think the super cycle wave 1 ended at the end of Bretton Woods, which is early 70s, and we had a wave 2 correction after that. And that's when the foreign countries started to decouple the peg and started having floating rates. And then again, we had a cycle wave 1 into the 1981. So this was very bad. Early 1980s, we had a very bad recession. It was deemed the worst recession since World War II, until we had financial crisis. And then it bottomed just before the dot-com bubble. And obviously with dot-com bubble, people started looking for safe haven assets, and the gold started to become favorable again. Had a nice run up beyond the financial crisis. And when the Fed started printing a lot of money in their QE, the surprising part was this wave 3 top. At the time, I actually started looking at gold just around 2011. So at the time, I think most people a lot of analysts were saying gold will go to 3,000. I think it never reached that level in that cycle. And it peaked a couple of years before the Fed started tapering. And it wrong-footed a lot of investors because people who made money in the housing bubble, the housing crash, a lot of them actually switched the assets into gold because of the Fed's QE printing, right? And I think even Greenspan, smart people like Greenspan, which is the former Fed chair, and a lot of hedge fund investors all switched to gold, but actually into the really big bear market that stopped in 2016. And from there on, we are now entering wave 5 of this super cycle, wave 3. I would say this timeline here is just for reference, because the earlier waves are quite good with price levels, but not very good with timing. So we still have some more. I think I'm quite bullish. I think we'll still have some more room to go in this chart. And I think the wave 5 top is in the mid 3000s. And so what's driving the price surge of late? So we can see the gold as an investment asset for the past 15 years. A lot of them are in physical bars and coins. I think Costco launched, like a physical gold bar you can buy in the supermarket, and people bought it up pretty quickly. ETFs, remarkably small and actually not that favorable in the past few years. We had an outflow. In total, it accounts for 1% of the annual demand. A big driving factor is the central banks, and it kind of explains why that cycle wave 4 bottomed around 2016. So if you look at from 2016 onwards, central banks, which is the bars in red, have really picked up the pace of buying gold, and primarily out of emerging markets, China, Russia. In the West, the Eurozone and US, they haven't really bought it. If anything, they began looking to sell their gold assets, but the US have held their gold bars for the longest time, and they haven't moved it as part of the reserve. So most of the central bank action sort of buying comes from the emerging market central banks. And if you look at zoom in on the BRICS countries, here you can see Russia has been buying pretty consistently quite early on, even before COVID. India as a country loves gold, physical gold. The central bank has been buying a lot. Brazil bought a bunch during and after COVID, and again China started buying since end of 2022. And I think and Russia as well. And I think what happened is that since Russia invaded Ukraine, the US froze the Russian assets in the Western countries to the tune of 300 billion, and that's about half of Russia's foreign reserve. And Russia started buying more gold so they can have greater control over the reserves. And I think China is taking cue as well. So China, whatever they want to do with Taiwan, and given their alliance with Russia, they're also quite concerned about potentially the US seizing Chinese, the dollar assets that belong to Chinese government, which the US can easily do. That's the biggest financial leverage the US has, because US is the world's reserve currency. And China is one of the top gold producers, and now is holding more gold as well. So I'm quite bullish on gold because of central bank buying. And in July, and I haven't shown this, I showed it in my article, but not here, we saw ETFs actually going up in terms of net flow in Western Europe. So the ETF flows this year have been very strong in Asia, but very weak in the US and Europe. But in July, it started turning up. So I think the investors are now taking cue to get into ETFs as well. And so I think on the larger degree, I have the wave 3 target just under 3,000, which we're underway. So that's roughly 20% from here, which is not bad. And on a smaller degree, essentially, I'm waiting for a pullback, as in we are close to the smaller degree wave 3 target here. And I think it's nicer to buy at the wave 4 towards the wave 5 high. But I think, if unless you're willing to sit on the volatility, still have the volatility. And another thing is in September, again, post-Jackson Hole into September is very seasonally weak for gold as well. So I just don't feel like we need to, add positions right now going into that September weakness. I think it's much nicer for that weakness to subside and buy into the beginning of October, for example, here. So these are the levels. So this is gold, the absolute gold dollars per ounce, and this is the GLD, which is the iShare. This is the SPDR Gold Trust ETF here. I think there's one more thing I actually wanted to mention, just going back on the larger chart. So for those who don't follow Elliott wave theory, you can actually make out a very nice carbon handle pattern here, where the handle is 0.38 to retrace of the body of this cup. And I think what we have as an Elliott wave target in wave 5 is a 1.2 extension of the body of this cup. So the traditional technical analysis also coincides with Elliott wave pointing to this direction. So I'm overall on a bigger degree, I'm very bullish on gold. And I think that's the end of the webinar. We still have another 10 minutes. I spoke quite quickly today because I didn't know if I can get through all of the material, but I think we have a nice 10 minutes opening up for Q&A. If you've got any questions, please just unmute yourself and feel free to ask. All right, it seems no one has any questions. Don't be shy. If no one has any questions, we can end the session today and call it a day, and I'll upload this to my YouTube channel. I will send it out for the recording. So thank you very much, guys.